come up with an interesting topic today as well. So today we have with us Pratik Oswal, the head passive fund manager at Motilal Oswal AMC. Then we have Shikhar Singh from Groww, and I am Rishabh Lunia from Nawabs Learning Academy. We will be talking on asset allocation with passive funds. So that would be an interesting topic which we would want our expert speaker to give us insights on. But before we get into the topic, I'll take you some interesting, I would say not interest, more than interesting, more idea on what is passive funds and what is index investing, so that when Pratik takes over, you exactly know what are the funds he's talking about and how you can help your portfolio grow in coming times. So quickly, I'll share my screen. Yep. All right. So the whole idea of today's session is, I think, doing asset allocation using passive funds. Last 1 year or so, we have seen markets go touching lows, then bouncing back with a kind of vigor it has shown. I think some of the investors could invest, some of them actually waited to get in, but they couldn't get in at time. So the whole idea of today's session is how we can use broader markets to build a good asset allocation and to give a consistent long-term performance in our portfolio. So for that, the very crucial thing is, what are the ways of investing, how a normal investor can invest into the markets. So broadly, I think all of you would have heard about the active investment, where the mutual fund invest on your behalf on select stocks after doing a proper research. And there is another way which is called passive investing. So today's focus would be on the passive investing, what it is, and how you can take advantage of this strategy in your portfolio. So passive investing is exactly opposite of active investing, where the fund manager is not burdened by selecting the stock or doing active research on identifying which sector to invest or which stock to invest. His core job is to replicate any index which the fund has chosen. So for example, just to give you an example, there are various indices all of us have heard, Nifty or Sensex, or let's say mid-cap indices. All of them are part of various indices, and passive investment tries to just replicate whatever may be their strategy. Now, if we have to talk on risk perspective, they are considered less risky when active funds, because you are actively not selecting any stock or sector. So you eliminate that portion from the selection risk which may come to your portfolio by getting into a passive way of investing. And it also brings efficiencies in terms of the overall expense ratio. It is considered one of the, I would say, economical way of investing into our markets. And the best part of passive investing is it is very transparent. You exactly know where you are getting in. Earlier, what used to happen is you are giving your money to a fund manager, and the overall objective was very broader. You don't know whether he would be investing in this sector or that sector. But thanks to passive investing, you exactly know what index that fund is going to follow and what kind of stocks you are getting into. So there is more control from an investor point of view, because suppose he wants to invest into a large cap index and he has chosen a large index fund, then he knows that my money is getting invested in large stocks. Okay, so what are various types of passive investing? So broadly, two things comes into our mind. One is the index fund route, and the other is ETFs. So today I'll talk a little bit on index fund, because Pratik will explore that side much more. So index fund, like your any other mutual fund, is a mutual fund, but the objective is very, very clear, that the fund manager will just replicate the index. So we can give you an example. If we are talking about Indian markets, if investor wants to know how the market is doing, okay, we don't go and look all the 6,000 plus stocks which are there. We just go and see how Sensex or Nifty is doing. That's it. Just these two numbers gives the direction of the market. And suppose you know that you want to invest on that direction, you just put your money into these index. But you can't buy Sensex and Nifty because they are just indicators. You cannot buy in that portfolio. So what is the second best option is an index fund which invests into those stocks and those sectors in the same weightage. So the idea of index fund is replicate in totality. So the idea is you are replicating exactly in the same proportion. Now, what is the end objective? The end objective is you want your portfolio to react in the same way how markets behave. Now, the other day I was talking to some of the investors and they're saying market is going up, but my portfolio is not moving in the similar direction. Why is that? And that predominantly happens because you might be invested in active funds, and fund manager, because of trying to outperform the index, sometimes invest in sector or stocks which may underperform in endeavor to outperform. So that you eliminate when you invest in a index fund, because index fund will replicate the performance of the broader market. And if you want to invest in global markets, then you would have heard of S&P indexes, Dow Jones, NASDAQ. Now we have these modern investments which invest in international funds, where you can take the exposure and give your money little more diversification. I would say the geographical diversification is also possible. And while doing this, you eliminate or you reduce the risk to a greater extent. So this is primarily how index fund works and how passive investment works. The IPL season is going on, and you would have heard that a lot of teams are picking more balance into their teams. So they are going out and spending all that money just to have a great balance. So what I would say is, when you get a passive fund or an index fund into your portfolio, the kind of diversification it gives, the kind of stability it gives, and at a lower risk, it's a great thing to have in somebody's portfolio. So with this, I would like to call Pratik to take today's topic and give our investors more insight on how this product can be fit into their portfolio, and what are the options which Motilal can offer to them to have an exciting investment journey. Over to you, Pratik.
Great, thanks, Rishabh. Thanks for the great introduction on passive funds. And really well said. Well spoken. So today I'm going to be guys, thank you everyone. Good to be back on Groww, and this is obviously one of my favorite audiences, and I really look forward to I think a great session with all of you. So today at Motilal Oswal, we're launching two funds. And both are completely 100% passive. And both are actually capturing on the entire, I would say the concept of asset allocation. So, I'm very excited to launch these two funds, and, would love to spend the next 15-20 minutes talking about these two funds, talking about the benefits, and talking about how, an investor can really get an entire portfolio in a single fund, through these two funds. So let me just share my presentation. So great. So I have been, heading passive funds for now almost a year and a half. And we've launched a lot of funds, almost, I would say, maybe 8 to 9 funds in the last year and a half. And the biggest question I get from investors is which fund should I buy? You've launched these funds, which is the right one for me? And today, I have a answer to that question. So today, so we've launched these two funds, and essentially both these funds are for different types of risk profiles. So if you're aggressive, you buy the aggressive FOF, and you're conservative, you buy the conservative FOF. So these are two funds. Both are multi-asset funds. So you can get access to multiple asset classes in these two funds. So, we are delivering, domestic equity, international equity, gold, as well as debt, all four asset classes in these two funds. And I'll talk about some of the benefits of having these asset classes of the funds. But before that, I wanted to, I think, Rishabh did a great job of talking about index funds and their benefits. Let me talk about the benefits of asset allocation. So asset allocation has become a gold standard for investing today. If you look at the last 4 or 5 decades, I think the one philosophy that has really stood the test of time has been asset allocation. So what is asset allocation? Asset allocation is how an investor allocates his money across different asset classes. So today, if you as an investor is investing in, say, a large cap fund or a mid cap fund or a small cap fund, that is not asset allocation. Asset allocation has to be across different asset classes. Large cap and mid cap is the same asset class, and there is not very little diversification that you could get if you're investing in multiple equity mutual funds. So asset allocation is, investing across debt, equity, international equity, gold, real estate, and other things. And within this asset allocation, there's two types of allocations. One is called a tactical, and the other one is called a strategic. Tactical is when you as an investor decide that today I want to have a 60% allocation to equity, but then 2 years from now, you're like, what? Now I want to be conservative. I only want to have 20% exposure to equity. That is tactical bets. So you're essentially gauging the market conditions and trying to see what makes sense at what time. That is tactical, and that is where most of the funds in this category are today. The other one, and this is the more popular one, is called strategic asset allocation. So strategic asset allocation is when you take a call for life. I, as not for life, but at least maybe 10, 15 years, that today, based on my risk profile, I will have a 60% exposure to equity, or a 30%, or a 40%, or an 80%, but I will keep it there for a very, very long time. And if it sort of goes beyond, say, what you decided, you bring it back to where it's supposed to be. So that is called strategic asset allocation. And these two funds that we're launching are 100% strategic asset allocation funds. So an aggressive fund will always be aggressive, and a conservative fund will always be conservative. So whether you buy this fund today or 50 years from now, you will have the same allocation. So which is why we have two funds, because essentially, if you look at this category in the mutual fund space, sometimes mutual funds tend to go aggressive or tend to go conservative. In this case, we have two different funds, and both have very different advantages because they're separate in terms of risk profile. So let's look at them. So today, if you look at all investors today, we love chasing the last year's performing asset classes, and what we've seen is that by choosing the last year's winners, so last year, the biggest winner was gold. If we chose gold and we did that every single year for the last 13 years, that's actually a poor strategy. You only make about 7.9% over a long time. Whereas if you do bottom fishing, which is actually the opposite, you buy the worst performing asset class, your returns are a lot higher. The best strategy is to have an equally weighted strategy. What that means is to have the same weightage across each asset class over and over and over again. And that is giving you the most. And this is an example of a strategic asset allocation portfolio where you will make sure that regardless of market condition, I will make sure that my equity will always be 25, my debt will always be 25, and vice versa, and sort of so on. So essentially, and this is not only an India thing, this is also prevalent in the US where I used to work, also in Europe, also in Hong Kong. So globally, what we've learned is that a strategic asset allocation is effectively the best way of investing. But why is asset allocation important, or why am I talking about it? And this is a very important slide. This talks about why asset allocation is extremely important for investors. And this is something which is most investors don't know. And this is obviously based on a very popular study, and there are multiple studies that talk about this. 91%, so 90% plus of your long-term returns is determined by asset allocation, not by which stock you buy or which stock you sell or which fund you buy or which fund you sell. This is extremely important, So how much you invest in equity, how much you invest in debt, how much you invest in international is basically determines 90% of your investment, of your returns over the long term. And only maybe 5% is on security selection, which is deciding, okay, whether should I buy this fund versus that fund? That is only 5%. So this is why asset allocation is extremely important, and which is why I really push all investors to really focus on what their allocation is, in their investments. This again a slide about who we are. So we are the only, just to give a primer. We've been in the space for about 10 years now, but we've taken it seriously in the last year and a half. We're currently managing close to 6,500 crores, and we have funds across all categories. We are market leaders in the international funds. So if you have any questions, I'll be more than happy to ask about any of our other funds. So let's talk about these two funds. We have two funds. We have the aggressive and we have the conservative. But secretly, we also have a third fund, which is the moderate, which is essentially just combining these two funds. So we had an option to launch the moderate one as well, but we're like, investors can just combine the two. So essentially, if you just do 50-50 of conservative and aggressive, you can actually come to a moderate portfolio. And essentially, how are they different? The aggressive portfolio is going to be about 70 to 80% equity, and the rest will be debt and gold. And the conservative will be the opposite, where it's going to be around 40% equity, and the rest will be debt and gold. So I think that's how you differentiate. The aggressive is good for investor who's looking at higher exposure to equity, And a conservative is someone who does not want that high risk. So say today's time, a lot of people are risk averse, people are fearing a market fall. For them, a conservative might make sense. But essentially, what we believe is that you should invest according to your risk profile and just stick to aggressive or conservative, or obviously moderate by combining the two. So these are FOFs. What are FOFs? FOFs are fund of funds. So they're basically a wrapper on underlying funds. So the funds that come inside this are funds that are managed by us. The gold fund comes from ICICI. So essentially, you're getting four underlying funds in each of these FOFs, and all four funds are a representation of the asset class. So Nifty 500 would be domestic equity, S&P 500 will be international equity, the GSEC ETF will be debt, and gold will be obviously gold ETF. And a very important bit that we also rebalance these portfolios on a quarterly basis. So if suppose you buy 60-40 equity and the 60 and there's a bull market, so the equity really goes up, we would rebalance the portfolio every quarter to make sure that your 60-40 is maintained for the lifetime of the fund. So we rebalance it for investors, and we also provide these four funds. But why do we have these four funds and not any other funds? We could have easily played around with this and showed you higher returns, but we as an AMC don't believe in showing high returns or trying to take the people and really like get them to invest in high return products. We believe in sort of having the right products. So Nifty 500 is basically an all market fund. You're essentially buying large cap, mid cap, small cap. You're buying 95% of India's equity in a single fund. So it's a great gauge of the entire Indian market. So that's why it's a great domestic product. The 5-year GSEC is something we launched in December. It has no credit risk, so you don't have to worry about someone defaulting. It's backed by the central government. But also, I think it's a great fund because it's a 5-year fund. So essentially, you can expect certain premium over, say, a liquid fund, but also not as much interest rate risk. So it's a pretty stable sort of fixed income fund. And to be honest, the reason why we like it is because this fund, despite being a GSEC fund, has outperformed 90% of all debt funds in India in the last 10 years. So it's really effective in delivering those returns, which is why we like it. The international equity, is S&P 500, super famous, probably the largest fund in its category in the world. And it's pretty no-brainer when it comes to international diversification. We also have the NASDAQ fund. The reason why we don't have the NASDAQ out here is because NASDAQ is not as broad-based. It's not as, it's also very sector and stock concentrated, whereas S&P is broad-based and I would say captures more of the US and the global market than the NASDAQ. And last one is commodity. The reason why we have gold is not because the returns. Gold returns have been pretty decent, not that great over the last few decades. But what we've seen is that gold is a good hedge against volatility. So whenever the markets are bad, gold tends to do well. So it really sort of minimizes and gives you that protection in case markets are badly. So these are the four asset classes that we have in these two funds. So let's look at the allocation. And this is the allocation for life. We won't be changing this. It's a strategic asset allocation fund. So what you see out here is what you will see 10 years from now, 15 years from now, 20 years from now. So the aggressive will be around 70% equity. The rest will be debt and bond and debt and gold. And the conservative will be around 40% equity, and the rest will be debt and gold. And if you just simply combine it, you can buy 65% equity and the rest. So essentially, you're essentially buying allocations. You're not really buying, I would say, underlying funds, which, as I said, is 90% of your returns in the future. So what are the benefits of buying these two funds? And this is extremely important. One is that you're getting true diversification in these two funds. Buying, as I said, buying pure equity funds, regardless of if you have a 5 mutual fund portfolio and all are equity focused, you see that last March, everything went down, whether you bought a mid-cap fund or a large-cap fund. Whereas if you bought a multi-asset portfolio, you would have got really good downside protection because gold went up, international equity went up, whereas Indian markets went down. So, essentially because you're having uncorrelated asset classes, and I'll show you some data that shows this, you're essentially getting a lot of protection and you're taking a lot of risk out of your portfolio while having high returns. So very important. Diversified, we have two options: conservative, aggressive, and also moderate if you want. Risk reduction, I'll give you examples of this. Very tax efficient, so this is a very important point. Someone asked me, why do I have to give this to you guys? I can just do it on my own, on my mutual fund app or on my computer. So because of the mutual fund structure, we as a mutual fund do not pay capital gains tax. So whenever you rebalance your portfolio, which is like buying your winners, selling your losers, that's a tax event, and we as a mutual fund do not do that. And we've done the math. A mutual fund rebalancing gives you 1.5% more returns than you doing it yourself. So we do feel that it's a very tax efficient form of rebalancing, which again is really helps in increasing returns. Again, low cost. These funds are 1/3 the cost of any other funds in the category. So around 35.3 to 0.4%. So very low cost, which I think, as I think Rishabh pointed out, is a huge factor for passive funds, and obviously it has rebalancing, which I talked about. So let's talk about correlation. Correlation is, to be honest, for me, the most important question. Whenever I ask someone comes to me with an investment proposal, the first question I ask them, how is it? What's the correlation of this with equity? Very important question. And these numbers might not make sense, but let me show you a graph. Now, this is a correlation of a large cap, mid cap, small cap, and a multi cap fund. Very similar, very similar. There is no diversification in this chart. But look at a multi-asset fund. There is no sort of, I think it's completely not correlated. So when equity does badly, you have something else do well. And when I would say equity does well, something else does not do well. So I think what we've seen out here is that, by having a non-correlated portfolio, you're making your portfolio a lot more stable. And I'll show you the returns. It's a lot more consistent over time because of this. I talked about rebalancing. As you can see out here, a fund rebalancing at the mutual fund level will give you around 13.5%, and whereas the investor level is 12.3. So there is some merit about leaving the rebalancing to the mutual fund, whereas doing it yourself. Let me look at. So this is the performance of these funds. Let me show some numbers that might be better. But essentially, and actually, let me just finish this slide. This is actually a very important slide. This is called an asset allocation quilt. So just I'll spend 2 minutes out here. Gold is yellow. Orange is domestic equity, which is equity. International equity is green, and blue is fixed income. As you can see from the color palette out here, it's impossible for us to forecast which asset class will do well at what point of time. It's impossible. You can't say tomorrow gold will do well, because it's very hard to say what will do well. So essentially, it's the best strategy is to have all four and keep rebalancing it, which is what I'm getting to in an asset allocation fund. That's number one. Number two is look at the downside protection. When equity lost 56%, 60% in 2008, these funds only lost 30 and 12%. And 2011, when equity lost 26%, these funds only lost, say, 5 and 0%. And even last year, I would say last year has been positive. But even last year, when equity markets lost 40%, these funds only lost around 10 to 25%. So I do feel that the kind of downside protection. So these sort of markets today, when everyone is expecting a fall or everyone is risk averse, it makes sense to deploy your money in a multi-asset solution, because you're getting downside protection and you're getting exposure to equity, which I think is extremely important. So let's look at returns. Obviously returns are very important, but not the most important. So as you can see, the more than the high returns, the consistency of returns is what impressive. It's always between 11 and 14%, and this is between 11 and 12%. So across different business cycles, what we've seen is that the returns are pretty much very consistent, because when one does badly, the other one do well, and vice versa. So I think this is a big pointer. And look at the risk. Your risk of an aggressive fund is down 50% compared to a Nifty 500. And the conservative one obviously a lot lower. So I think what you're getting is a fund which is consistent. You're getting something which has decent returns, and you're getting something with a lot less volatility, which will help you stay invested for a very long time. And you're getting something which is like an all-weather portfolio, which will do well in all market conditions. Which are so as you can see, these are the crisis situations that we've had in the last 10-15 years. And this is what equity has fallen. This is what international equity has fallen. But these portfolios have barely fallen. By barely, I mean maybe half or 25 to 50% less than what you would see out here. So essentially, you're getting downside protection. And today, I think a lot of investors, are fearing markets, because markets at all-time highs, international and domestic. Gold is the highest performing asset class last year. Debt yields are quite low. So how do you put your money? The answer is put your money in a multi-asset solution, because it's an all-weather product. It'll do well in most market conditions. So let's look at similar opportunities in this space. As you can see, the cost effectiveness is quite high, and this is the regular plan. The direct plan is probably a lot lower than this. So you can see, I would say direct plan is half of this. But as you can see, the returns are pretty much better than most other funds in the category. The reason why I say this is because the most funds tend to be tactical asset allocation, where this is only strategic asset allocation bet, as I talked earlier. So I do feel that this strategy of having the same asset allocation for a very long time really works well over the long term. For investors who are looking at debt but who want to be a little bit more aggressive, a lot of people compare our conservative fund of funds, which is 50-60% debt, to a debt fund, and as you can see, the returns have been a lot higher. So if you are obviously conservative, or if you are conservative at this point of time, this is a great fund where you get much higher returns than any other debt fund, but you also get slightly small sort of exposure in gold, international equity, and domestic equity. So I do think that this may not be a fair comparison, but just putting it out there for someone looking for an aggressive debt fund. So that's pretty much, I would say, my presentation on these two funds. I hope I've answered a lot of questions on asset allocation, the importance of it. These provide an entire portfolio to a fund. So I do believe that investing should be minimalist. Investors should not have more than 5 to 7 mutual funds in their portfolio. And I do feel that this one fund is more than enough, for anyone who's looking to invest. You're getting an entire portfolio in a single fund. So I do think that this sort of fits the bill for most investors, and they should be happy with this without having to worry about which fund to buy, which fund to sell. So that's pretty much my and lastly, I think a lot of people talk about return, but I do want to focus on the importance of risk. Risk, I think, is in control. Return is not in your control. And I think these funds, the reason why I like these funds, we've designed these funds for risk and not for return. For example, we have no credit risk in this fund. We have no market timing risk in this fund. The Nifty 500 takes out sector size risk, so it's an all market fund. And also, more importantly, it does not have domestic risk because we also have international funds in the portfolio. And we further lower the risk by having gold in the portfolio, which has a negative correlation to equity. So I think we've really designed the portfolio in such a way that we want to minimize risk for the customer, and we've built an all-weather product that someone can invest in and keep investing for a very long time. So thank you so much. That's my presentation, and look forward to the Q&A session. Over to you, Shikhar.
Thank you. Thank you so much. Hello, everyone. Welcome to Ab India Karega Invest. I will be very quickly walking you through the product that Groww is and our offerings, what else is new, what you can do, and so on and so forth. So I will very quickly share my screen here. Right. So when you download the app, this is the screen that comes to your on your phone. You have the option of logging in or signing up using your email ID, which could be any other email ID or also a Gmail ID, which is where you have the option of continuing with the Google ID. It's 100% paperless. Everything that you do on Groww is paperless. There's no signing of papers or anything like that. There's no sending across or anything. It's all paperless, all possible via your smartphone or your laptop. And even if your KYC is not done, we will get it done digitally for free. Now, when you log in, this is the screen that you'll see. This is what we call the Explore screen. And right at the top, you'll be able to see there's a search bar where you can type the names of stocks and mutual funds that you want to check out. And using that option, you can go to any stock page or mutual fund page and see details about that product. Now, as you can see, there are 3 tabs here. There's stocks, mutual funds, and gold. In each of these, you have details pertaining to that. So this is basically the Explore screen of mutual funds. Likewise, if you tap on stocks, you'll go on the Explore screen of stocks and on gold. So this is what the Explore screen of stocks looks like. And this is what the Explore screen of gold looks like. As of today, we have one digital gold option, which is served by Augment Digital Gold. In the future, we will be adding extra other digital gold options, and you will be able to invest in those also. Now, this is the fund page. This is when you type the name of a mutual fund or you search the mutual fund and you tap on the name, you end up on a page like this. And on this page, you will be able to find every possible detail of that mutual fund that you as an investor must know of. As you can see, there are there are some easily available data right at the top, and at the bottom you have different tabs on which if you tap, more details will pop. So you have returns, you have pros and cons, you have fund overview, many other details like fund manager's name, names of funds in the same category, competing funds, their returns, and so on. Likewise, this is the stock page, where again you will find all possible details regarding a stock present here. And similarly, this is the gold page, where you will find the detail of the digital gold offering, which is in this case Augmont Digital Gold. And here you'll find the minimum amount to invest, purity, how many carats it is, and so on. Now, the thing with mutual funds is many people believe, especially in our country, that mutual funds is a monthly affair where you have to invest via SIP. It has to be monthly, which is not true. You can invest one time also. And it's not necessary that if you're already investing in one way in a mutual fund, you don't have the option of the other. So if you have an SIP running, you can still do a one-time investment in that. If you have an SIP running, you can do another SIP also. And if you have done one time, you can also do SIPs. There's no limit to the number of SIPs or one-time investments you can do in one mutual fund. And of course, I'm assuming you'd already know that there is no limit to the number of mutual funds you can invest in also. Now, this is the dashboard. As you can see at the bottom, there are three buttons. There's Explore, there's Dashboard, and there's You. So when you tap on Dashboard, this is the screen you come to. And at the top, you'll be able to see there are three tabs. There's Stocks, Mutual Funds, and Golds. And in this particular screen grab, we're on the mutual funds page. Here, you'll see a list of all the mutual funds that you own. Likewise, if you tap on Stocks, you end up on the page that shows the stocks that you have invested in. And Dashboard is really it's the summary of all of your investments. It tells you how much you've invested, how much returns you're making, and you can toggle and switch and see how much the percentage is, how much the money is in rupees, and how much it has increased, so on and so forth. Now, in each of these cases, if you tap on these mutual fund names, you'll get the option of investing more or withdrawing. And if you click on more details, you'll be taken to a page that looks somewhat like this, where it's similar to a passbook, where you can see all your transactions in that mutual fund since inception, and other details like average NAV, folio number, and so on. Practically all payment options are available to you on Groww. You have UPI apps, net banking, and NEFT, RTGS, IMPS. Now, import and switch. So this is one of the most popular features we have on Groww. Let's say you have mutual fund investments that are not on Groww, that you had invested using some other platform or using some other source. And now you'd like to have it in one place on Groww so that all your mutual funds are together in one place. And it's easier to track and see your investments progress. So you can move whatever mutual fund you have to Groww. And that is called importing. Go to your dashboard, scroll all the way to the bottom, and you'll see the option of importing. Tap on that and just follow the instructions. Again, it takes only 2 minutes and all your mutual funds will be visible on your Groww dashboard. Now, once you have tracked them, once you have imported mutual funds to Groww, you also have the option of switching them to direct. A lot of people, when they invest in regular mutual funds where they're paying a commission. And if you want to switch to the direct plan, which is the zero commission plan, you can easily use the switch option and change your plan to direct plan. But obviously, you'll have to first import and then switch. If you have any doubts, any queries, anything you'd like to know from us, please reach out to us over email at support@groww.in. This is our email ID. And besides this, we are also available via our help and support section. You can raise a ticket and you can call us, email us, or chat live with us. Please follow us on Facebook, Twitter, LinkedIn, and YouTube. YouTube is a very good resource that we constantly keep building. We recently crossed a big milestone, which is 5 lakh subscribers on our Groww YouTube channel. And we put up videos that are meant to help and help new investors learn about investing. couple of other things about our app. We are one of the highest rated investment apps in the country. Practically every mutual fund is available on our app and website. We have over 1 crore users. We are SEBI and AMFI registered. We use 256-bit encryption, and we're also an ISO certified company. With that, I come to the end of my presentation. Now, we all will join back and we'll take your questions.
Thanks, Shikhar, and thanks, Pratik. I would like to quote you. I think return is not in our hand and risk is in our hand. So we need to build our portfolio very carefully. So that summarizes what Pratik had to offer, and the product, both the product what he offered looks very, very tempting at the current market conditions. So with that, let's start the questions which I think viewers have been sending to us. The first one, I think somebody wants to know on the small cap and mid cap space, what are the indices and what are the options available? Like more on the performance side.
On the smaller mid cap space, right? So on the smaller mid cap, if you're looking at indices, then there's only actually. So we were the only. So I think Motilal Oswal was the only AMC with a small cap index. So now you have, I think even Nippon has launched a similar small cap fund. It's essentially a small cap 250 fund, which is so essentially if you look at the entire. So just to give a background, so in India, the top 1 to 100 is large caps, 101 to stock number 250 is mid cap, and 250 and below is small caps. So in India, you can actually buy funds across all caps. In the small cap sector, you can buy the top 250, which is stock number 251 to 500. So we have a fund which tracks that. So you can buy that. Even Nippon has a very good fund. It's exactly the same. So you can buy that too. So that's the small cap space that the question. And in the mid cap also, you have the mid cap 150, which captures the entire mid cap index. You also have, I think, a mid cap 100 ETF, which we have, and that is also one option if you're looking at the ETF space. In terms of options,
at the current levels, are these space good to look for long-term investments?
Yeah, obviously. So so I don't know what the markets are going to be tomorrow, day after, 2 years from now. I honestly really don't know. I don't have a view on the markets, but I do feel that small and mid cap is something which is meant for a very aggressive investor. So if you are able to take that additional risk, then small and mid cap might be a good option. I would say that. I think most investors are pretty much okay with large caps. But if you are able to take this higher volatility in investments, then mid cap might be a good buy.
Okay, thanks. And do we have SIP plan in all the index funds which you are?
Yes, yeah. So there are SIP and lump sum both. So investor who wants to build up his portfolio slowly can also do an SIP approach. In an SIP approach, obviously there is zero market timing risk. So you're completely taking out market timing. Even if you invest in the absolute peak of the markets, then SIP is super safe because you're basically averaging your investments down. Just make sure you don't stop your SIPs.
True. Okay, and what are the ways of investing? I think you talk about international funds, and I think you have a few funds which take exposure into international indices. So can you just quickly run through what are the good options which people can explore?
Yeah, sure. So I have been talking about. I've been shouting about international diversification for almost 2 years now, and finally I think it's beginning to shape up. So and obviously I have been lucky to benefit of that. We have 2 good funds there, but there are a lot of options out there. There's active options, there's passive options. Obviously, in active options, you are looking at paying higher fees, but you're also looking at the opportunity of getting higher returns. Unfortunately, if you look at international markets, especially US and Europe, markets are very efficient. So, I think outperformance has been almost zero for most of the funds in the developed market space. So if you are looking at international markets, then, most people would recommend, sticking to index funds. So you have the S&P 500 fund, which we launched last year in March, which is very popular. It's actually the world's largest index fund. Was launched in 1970s, and now post 50 years, it's now become the world's largest. You have close to $3 trillion being tracked in that fund. So that's one fund that you can look at, where you're buying the entire large cap space in the US. And also it's an international fund because it has significant exposure in international markets as well. So for example, Apple has a pretty big market in India. And then you also have the NASDAQ fund, which is even more popular. NASDAQ is more tech focused. So if you're looking at a higher exposure towards tech and slightly, then obviously the NASDAQ is might be a better play, but a little bit more risk. So these are two of the most popular, I would say, at least in India. But I would recommend investors to also look at other geographies. So don't stick to US. Look at, we don't have funds outside of the US, but you should look at say emerging markets, developed markets, because that's more of a diversified, that's a better way of diversifying than just looking at the US.
All right. And somebody wants to know the NASDAQ, you talk about NASDAQ 100 fund, how that is different from the two funds which we are launching now.
Yeah, so the NASDAQ is a pure international fund. So 100% of all your money is going to be invested in the top 100 stocks listed on the NASDAQ exchange. So if you see the, so it's a mutual fund. So you'll see Apple, Google, Netflix, Facebook, all these companies. So your 100% of your capital will be invested in the US. Whereas in these multi-asset funds, we are actually investing in multiple asset classes. So for example, for the aggressive portion, only 20 out of say 100 rupees will be invested in the US. The rest will be invested in gold in India, in the Nifty 500 in India, as well as the debt in India. So essentially what you're getting is the NASDAQ is a fund that gives you exposure to equity as an asset class in the US. Whereas our multi-asset is basically a portfolio solution where we're giving you all four asset classes within one single fund. So that's basically the big difference. Yeah, yes, we are giving you exposure of the S&P 500, but it's relatively small. If you want a much larger exposure, then I think you should go and directly buy the S&P 500 or the NASDAQ.
All right. I think that was quite informative. Another listener, viewer wants to know about, he's a beginner and he's starting his portfolio now. So how index funds can be placed in his portfolio to start with?
Yeah, great. So yeah, so I think index funds, the reason why I like index funds is because not only is it good for sophisticated investors for their core allocations, but it's absolutely great for investor, because today if you look at the mutual fund space is extremely intimidating. There's like 5,000 funds, there's 40 MCs. You really need to know what you want to buy. And I think I keep telling people is that buying a mutual fund is not like it's like choosing between 40 different type or 5,000 different types of hair dryers. So it's very difficult for you to see which one is good, which one is bad. So index funds make it a lot simpler, because those 5,000 options come down to say 5 or 10. We've seen the returns have been pretty good, I would say, better than most of the actively managed mutual funds. So it's a really good way of someone to get a starting exposure towards equities. And obviously, over time, as you build your skill set, as you build your knowledge base, you can also look at funds outside index funds. But I think it's a great way to start building your equity wealth.
So that about index fund. But now if suppose I have 10 of index fund, how do I bottom down on one or two? What are those couple of important parameters to select index funds?
Yeah. So, I think it's a great question. So I don't think you should have 10 index funds in your portfolio, because essentially, it's sort of, I would say that, maybe it really depends on what type of index funds. You have index funds in debt, in equity, in gold, in fixed, in international. So if you're having 10 index funds across different asset classes, then that may be okay. But if you just have 10 index funds in just equity, then obviously something is wrong. So I would say that, stick to maybe 2 or 3 index funds maximum. Even one is enough. Nifty 500 or even a Nifty 100 or Nifty 50 is more than enough for your equity needs. And you can look at, say, like a gold fund or like a debt index fund or even like an international fund. So ideally 4 to 5 is something which I would recommend, but which are across different asset classes, not the same asset class.
Shikhar, I think one viewer wants to know about the FNO option. Is it available on Groww platform for stock trading?
No, it's not available as we speak, but it has been developed and we are internally testing it, and it should be available very soon. We avoid putting out products that we haven't extensively tested it. So it's definitely 100% ready. It's our entire team of hundreds of people are already using it. As soon as we're very confident that it's good to go, we will be releasing it. It will come on the website first, and then gradually after that, it will be rolled out on the app.
Great. Coming back to you, Pratik, somebody wants to know for the aggressive FOF, what should be the holding or the tenure which somebody can have in mind to look to invest, and what kind of risk profile?
For the aggressive one.
For the aggressive one.
Yeah. So for the aggressive, you have to have an aggressive risk profile. So you should be. I think risk profile is to do with how much volatility or how much short-term downside you can take in your risk. So if you're not able to take, so markets crash all the time. Markets, that's very normal. And if you can't take a big enough crash, then obviously you can look at lowering your risk by choosing different funds or different allocation. So I do feel that if you're an aggressive investor, if you're able to take that much risk, and if you're able to take short-term losses, obviously equity in the long term is always up, always upward trajectory, but in the short and medium term, anything can happen. But essentially you have to just keep investing over a long time. So essentially, if you're okay with slightly higher volatility, then obviously you can go for an aggressive portfolio. I would say a minimum of 3 to 5 years is what you should look at. I mean, any equity investing, you should be looking at it from a minimum 5 years, at least in my books, but 3 to 5 years is something which I really recommend. Do not even look at equity as an asset class. If your horizon is less than 3 years, you should stick to fixed income, stick to, say, like a liquid fund or FD if it's below 3 years.
So I would just rephrase the question a little bit. Is like, if I'm a retired investor at 60 and I have a horizon of 10 years, so I'm not looking at any outflow immediately. I'm ready to park it for 10 years. Can we look at aggressive FOF as a good investment?
For 10 years, yes, you can.
Yes. Okay.
You can. Yeah. Also, I think one big misconception in the industry is that age matters. I don't think age matters. You can be 85 years old and saving for your great grandkids, and you can have a super aggressive portfolio. You could also be a 30-year-old and be saving for a house in 5 years' time, where obviously you'll be conservative. So I think it really matters about what your goals are and what you're saving for. That really should determine what your risk profile should be, and obviously your ability to take volatility. So combination of those two.
That's very important. I think a lot of people go by age, that I'm young and I have to invest in equity only. So that probably may not be the case, because as Pratik mentioned, your goals, whether they are short-term, mid-term or long-term, should ideally keep in mind, and based on that, you need to take a decision. So can index funds beat the large cap active fund returns? So somebody who wants to know on the, is it possible? Yes, no, and in what market conditions?
Yeah. So I honestly, historically, they have last 3 to 5 years time, large cap funds have been underperformed by index funds. But also what we've seen is that last 5 years, the the market performance has been quite flat. So markets are only sort of up. I think last 5 year performance is not that, last at least 3 to 4 years has not been great. India Inc. has not delivered in terms of, I would say, profitability, which is why the indexes are quite flat. And what happens in a flat market, the cheapest fund tends to be the most outperforming, which is why you see index funds doing well. Honestly, I don't know what will do well in the future. Obviously, India, I think it's a safe bet to choose index funds in large cap category. But I wouldn't say for a fact that all index funds will outperform all large cap funds.
And another, I think, viewer has invested in your Motilal Nasdaq 100 FOF, and he wants to know what kind of overlap will be there, because he's also planning to invest in these new funds. So will it be a great overlap, or there will be just a small significant portion?
No, so there will be there. So I'll tell you the overlap between S&P and Nasdaq. It's very less, about 30-40% overlap between Nasdaq and S&P, and in aggressive fund, S&P is only 20%. So the actual overlap will be maybe 3 to 4, maybe I would say 5 to 6%, or maybe 7%. So not
10%, I think.
Yeah, they're completely different funds. So I would say don't worry about the overlap at all.
Okay, perfect. And what is the risk of GSEC in fund of funds? So I think because there is some debt allocation also. So what is the risk which this fund may get in the near future?
Yeah. So it's a good question. So debt is obviously also risky. It's not like debt is risk free. The reason why we like GSEC is because it's risk free in the sense that you will be paid, so there won't be any capital loss. But the risk that you may see is interest rate risk. So the GSEC fund is a 5-year fund, so where there is some interest rate risk. So if interest rates spike up like crazy, then obviously you will see some small losses in the GSEC portfolio. We haven't really seen that that same trend in the last 15, 20 years, but obviously, as I said, anything can happen in the future. But the beauty about these funds, the way they're designed, is that the GSEC in the conservative fund is only 50% and 50-60%. So the rest of it is like, gold, international equity, and domestic equity. So, we've seen that, it's almost impossible for all four asset classes to go down. So essentially, by having multiple asset classes, you're also hedging some of the risk associated with owning debt funds.
Great. And why Nifty 500, not Nifty 50?
Yeah, so number one, Nifty 50 obviously is a great fund, but Nifty 50 is only half the large cap index. So you're missing out on half the large cap index, you're missing out on the mid cap index, you're missing on the small cap index. And obviously Nifty 50 also is a little bit concentrated with the top 10, 15 stocks, which obviously may not be long term, but I do feel that it doesn't really capture India. The Nifty 50 captures 10, 15 companies of India, whereas I want to buy domestic equity. I want to buy equity as an asset class. So you're essentially, by Nifty 500, you're buying an all market fund, which captures 95% of the entire Indian market in a single fund, which I think is quite significant. So you're essentially buying multiple caps, and you're also taking out size and sector bias out of this equity investing, because you're investing across size, and also you're investing in a lot more sectors because it's much more broad-based. So which is why we prefer the Nifty 500.
Okay, and there is a viewer who wants to know, at these levels, is it safe to invest in index fund at these level, or should he wait and enter at a later time? So what would be the ideal strategy to get into index funds? I know it's a difficult one.
No, it's the easiest question of all. Peter Lynch, who's one of the most famous investors of all time, said that more money is lost in waiting for a correction than in corrections themselves. So I honestly, people have been waiting for a correction for 6 months now, and honestly, market timing does not work effectively. We've learned it, and there's like countless of studies. There is zero studies that talk about why market timing works, but there's thousands of studies that talk about why market timing does not work. So I wouldn't recommend you waiting for something to happen or waiting to something to happen. Just invest. And if you're risk averse, then do an SIP. It's simple. You're taking out market timing risk. And if you're even more risk averse, then buy a multi-asset fund because you're allocated in multiple asset classes. So I think there are multiple ways of getting access to equity markets, and this is one.
Okay, I think one last question. You mentioned about an inbuilt balancing feature in your portfolio.
Yeah.
So how does that work, and can you throw some more light on it?
Yes. Yeah. So so if you look at rebalancing is an extremely important tenet of investing, and rebalancing is the secret sauce of how you can really optimize your returns, but also make sure that your risk is minimized. So what happens is, just to give an example, say you have an equity debt portfolio, and you have equity 60 and debt 40. Obviously, an equity will grow at a much faster rate than debt. And what if that 60 becomes 65 over time? That means you're taking a lot more risk now than you did 6 months ago. So what we do is, when you rebalance a portfolio, you get that 65 back to 60%. And what happens is, because of this mechanism, you're always selling high and you're buying low. If equity falls to 55%, you're buying equity. If it falls to 50%, you're buying more equity. So essentially, what this does is, this sort of rebalancing, which is called strategic rebalancing, you always end up buying low and selling high, which is exactly what you want to do as an investor. Most people, mind you, do the opposite. Most people end up buying high, and as it goes up, they buy even higher. And they tend to sell their losers and buy the winners, which is exactly the opposite thing what most investors should do. So this is the importance of rebalancing. So in this fund, or these two funds, whenever the weightages change by 5%, we bring it down to the target allocation of what it should be. So by ensuring that the risk is consistent across the life of the fund.
Great. I think we are done with our questions. Thank you so much, Pratik, for giving us insight on passive investing, and especially with these two funds coming in. I think people who want that kind of asset allocation strategy in their portfolio, these can be an ideal choices. So thanks for your insight on the topic. Thanks, Shikhar, for your inputs as always. And thank you, viewers, for joining with us for this session. It was great having you again, and see you again next week with another expert and another interesting topic. So till then, stay safe, stay healthy. Bye-bye.